think it's good. All right. All right, because you can't do all these groups and unless everybody's here, so bear with me. All right, so I'm going to go through a couple of things first, and then we could talk about your discussion. So the discussion board, thank you for putting in the discussion board. I have not been clear about what I'm looking for. So many of you actually reply to every post. I'm not looking for that. I just need you to reply one post. You don't need to reply to everybody, just one person, one post. That will be enough. Because otherwise, I think there's a lot of duplication from what you're saying to each other. So that should save you a little bit more time the next time when you do the discussion boards. So overall, great job on the discussion board. In terms of the case study, for the most part, everyone do a pretty decent job of interpreting the case study. And the primary goal here is to help you read the case study from a client's perspective. So you could potentially help a client, even though this is a planning firm. But also at the same time, I want you to look at your own practice if you actually have your own practice. Or if you work for somebody, I want you to look at that from that perspective as well. Because ultimately, at some point, your company would have to address the succession at some point. In terms of the succession planning, it ranged from anywhere between 3 to 10 different steps. Many of you have various different interpretation. However you interpret that, that's fine. But I think that the most important thing that I see missed was that oftentimes people are not focusing on that business model. Business model and overall strategy drives how the succession plan actually works. So I would say that the very first step is really have a company strategy and have the company business model revised first. Both of the companies that you see in the case study are actually two clients of mine. And that's the very first step you go through. You go through their business strategies. Of course, you're going to go through the goals and objectives, but they all have to align with the business strategy because that will have an impact on how things actually work in terms of the planning steps. So keep in mind that as you work with clients, business owner clients, or at some point you're looking into your own succession planning, that focusing on the business models. The business model that you did last week, that was the intention. That was the intention of letting you know that having that very first set of the business model, and typically when we do business model is you look at your current, and one or two of you actually mentioned this really well, is that succession planning is not just for the owners, they're also the entire team. So team has to be involved. So that business model is not just current. You look at 3 years, you also look at 5 years. So you literally have 3 different models. You're trying to see progressions of it. And ultimately, those model is going to drive how these planning steps is going to evolve over time. So keep in mind that as you work with clients or consult with the business owner clients, these are all the things that you need to take into consideration. In terms of the literature review this week assignment, I wanted to kind of give you a little bit background of it before you start your writing. I know some of you had already started, but some of you still have questions. In your research questions, that document that some of you have already revised, and I read them. And so you need to go back to that document, revise some of the suggestions that I have in there and correct them before you start writing the 4 or 5 different articles. And the 5 articles that you identify in the research question, those are the ones you're going to be writing off. There are 2 sets of the 5 articles. The very first set is the one that you're going to be writing this week. And then the second set, you're going to do that next week. Specifically, what I'm looking for is, yes, there's going to be a high-level summary. And also, you need to also talk about Do you agree? Do you not agree? And why do you agree and not agree? And are there any gaps? If there's any gaps, and ultimately what you wanted to make a connection to your research. So not only you're reading the article, you also have to see how relevant is this article actually related to my research. So I'm going to give you an example here. So let's assume that we are at an event, okay? And I'm just going to put some names on the screen so it makes it more relevant here. Let's say that we're on an event. And Ari actually has a research paper about middle market capital, okay? And David have a private Pepperdine's capital market trend lines, the latest trend lines. And Eric has the selling multiples. So when I do the literature review, I will have a summary of each. Think about it as just like you are having a conversation with this author, if you will. And then I'm going to then find out from that summary what information is the connection point to my own research, if you will. Because you have a research questions that you are answering. So you wanted to be able to see what are some of the connections. So you make those connections accordingly. And these are the things that will show up in your paper, in the literature review section. Okay. And in terms of what you agree, not agree, and gaps, and so for the most part, I could say that I don't have to literally say I agree. I could just simply cite what Ari talks about in the middle market capital. I could just simply cite that indicating I'm agreeing with what he's saying. I can simply cite Dave's current trend of the cost structure or expected return. And then I can simply say, well, I don't actually agree on Eric's selling multiples because there are all the other factors. Therefore, because I don't agree, there's a gap from his research. And that gap is what I am going to research in my own paper. Okay? Does that kind of make sense? Because I know some of you have questions. I want to make sure that you understand what to proceed in terms of the literature review portion of it. And when you actually combine them together, so let me go back to the previous screen. So when you combine them, when you combine this week 2 revised writing, just take out all the questions that I have for you, take those questions off and combine them into really just, they are probably your introduction, research questions, sections, and maybe just a background there. So that first paper that you wrote, answering every single one of the questions, that turn into an introduction, background, the reason you're doing this, and why you're doing this, and your research questions. And then so you combine that first portion to this second piece, and this second piece is literally your literature review of a summary, of a connections. Why are you agreeing? Why are you not agreeing? Are there any gaps that you're using to illustrate your research? So that's pretty much what I'm looking for in terms of the week 4 assignment. So the biggest issue you're going to run into in this week is that, let's say you have 5 articles. After you read through them, maybe 2 of them is useless. Maybe 2 of them is not what you expected. And you have to quickly find another 2 to fulfill that. Otherwise, you don't have enough literature review to justify your research, okay? So does anyone have any questions?
So this is like a running document.
This is a running document. You're adding modules every single week. And I will be giving you feedbacks to make changes accordingly.
And then as far as finding research and articles, I guess like I think I do understand, but what you're saying is that there might be like segments or portions of your research that you read that doesn't that you might not necessarily like agree with certain
Mm-hmm.
sections of, right? Because like
Yeah.
otherwise, if you find a research article that you don't agree with entirely, why would you choose that to even
Well,
be included in your source, right? Or as
that
a
means
source.
that research you don't agree with must have a gap that you are addressing in your article. And
Oh,
that's
okay.
that's basically you're expanding that piece of research, if you will. So for example, when Benjamin first come up with the 4% withdrawal rule, which he did it entirely in Excel, not even any simulation.
Mm-hmm.
So of course, there's going to be so many disagreement of it. And then later on came about Trinity research. Trinity research basically dispute what that 4% rule was. And they run through a very heavily simulation to test out various different scenarios to see that. So when Trinity study is, what they did was they disagree on the 4% rule. And hence that becomes a gap. And that gap's actually being researched in the Trinity study. Hopefully that makes a little sense there.
Yeah, it does.
Okay. Any other questions in terms of the assignments on week 4?
I have a quick question. So
Okay.
this may seem obvious to everyone, but so before we were researching and having 10 reference points or peer reviews, right?
Mm-hmm.
Now we're paring those down to 5. Is that correct?
No, you're just taking the first 5 of those 10 articles that you picked to write in this week. And then next week you write the other 5.
Oh, that's right.
Yeah.
Okay.
So you have 10 of them. So this week just focusing on 5. Chances are hopefully that all the 10 you could use. Sometimes you may not be able to use them.
Okay.
Simply you can't find any relevant point to that. So you may have to drop it and go somewhere else. You may have to find new articles.
Okay. So you're just helping us chunk it down.
That's right. Basically just do one little chunk at a time, so not too overwhelmed to submit something at the end of the term. Okay.
Got it. Thank you.
All right. Any other questions?
Yeah, I have questions.
Okay.
Sometimes in the research, they will actually often in the research in the conclusion, they'll note what the gaps are or what further research could be utilized.
Yeah.
Can we reference that? Or are you looking for us to make brand new connections?
You can reference that. Yeah.
Okay.
You certainly can reference that if that happened to be what your research is.
Okay.
Yeah.
Thanks.
I have a question that's not related to this, but just about like our weekly assignments. I don't know if we're going to cover that later though.
What about the weekly assignment?
Well, I was actually just going to ask one, if like what the midterm survey is, but then 2, I don't see that there's a presentation in week 5. So are we doing do we like need to prepare a presentation?
Week 5. Midterm survey is simply a survey asking how are you doing so far? Any changes you like to see that? So 5. I thought we have week 5, we have a group presentation, don't we? Yeah, we have a group presentation, we have a discussion, we have literature review. So there's not a case study, if you will.
So I don't see the group presentation in week 5. I don't know if it's like hidden again, but
it could be. All right. So let me make sure I have it updated after today's class.
Yeah, I didn't see that either.
Oh, I have this, we have a center called Center of Technology and Learning. They were the one pretty much messed up my entire Blackboard. I had it all squared away, but then somehow they got involved and things changed. All right, I will double check on that. All right, so thank you for pointing that out. All right, any other questions? All right, so here's what I'd like you to do. I'm gonna put you into the breakout room and I'm going to ask you to discuss the questions. And these are the questions that is actually in Google Drive. Take a look at them and pick the questions accordingly, because some of you have multiple questions within a question. So, so just pick the questions accordingly, how you're going to address it. And then, and how you're going to actually do that in your presentation. So who's going to do that, so to speak. So I'm going to give you about 5 minutes to do that. But at the same time, I'm going to ask group 1, which is Eric's group. I'm going to ask you to start from the outside transfer retire. Anything that is an overview, I want you to skip. Because I wanted to save time for you to talk about just focusing on the retire portion. So this is, you're going to use this time also to talk to your team how to reshuffle who is going to talk about what portion of it. So give me a moment. Let me see if I can.
So you're saying for our group, that entire business transfer intro section to skip?
Yeah, you can skip that. Yeah.
Okay.
Yeah, that's a pretty straightforward portion of it, so you can skip that. Okay, great. I think we have everybody there. So be sure to talk about what questions you're going to address, who's going to address those questions within your presentation, and group 1, in addition to that, figure out your slides, who's going to present what, because we're going to skip the first few pages of your presentation, if you will. All right, so stand by. Okay, welcome back. Hopefully we got everybody back. Okay, group 2 is back. Group 1 is still talking.
You just want us to go?
Okay, cool.
Let's start.
Okay, I think everyone is back. All right, so I believe the last time was group 2 went first, right? So group 1 could go first this week. So whoever wants to share the screen, you could do so.
Perfect. I'll do it here.
Okay.
And everyone can see that.
Yes.
All right. So I know that we're going to skip the entire intro portion, but I'm just gonna like click through the slides so you guys can see how pretty it looked at least. And then Ari, I think yours was
Starts on negotiated transfers. Perfect. There it is. Okay, so we can start here, and can everyone hear me okay?
Yep.
Okay, perfect. So then, yeah, of course, please take a look at our PowerPoint after the class, or you can review the slides. You can see everything if there are any questions. But we'll start here. So negotiated transfers. So what are they, and why do they matter in the context of middle market finance and this class? So we'll start with the definition. So by definition, a negotiated transfer is when one or more buyers are identified and then negotiated with independently. Negotiated transfers can be carried out through a variety of different transfer channels, including but not limited to employees, charitable trusts, the public, and other family members. And there's a question at the end that we'll address that relates to this as well. So why would a seller use a negotiated transfer within the business ownership transfer process? This is simply because people value their privacy and the privacy of their companies. Negotiated transfers are utilized to maintain confidentiality regarding the prospective transfer, possibly to maintain proprietary information, such as business methods or other sensitive financial information that they would not otherwise want disclosed during a more open business ownership sale. So what are the steps? To carry out the process, there are 5 steps. In order, the process or the steps are: execute a confidentiality agreement to make the transaction discussions private. Number 2, carry out an informational exchange. Number 3, execute a letter of intent to make sure that the parties are serious. Number 4, carry out the buyer due diligence, which often includes inviting the buyer to the business or having even letting the buyer inspect financial records or have their own professionals take a look at the business and give their opinions, draft definitive agreements, and if everything goes well, the last step is closing. The SLE notes that negotiated transfers are often used for smaller deals where the seller doesn't necessarily need to sell right away and will often only sell if the deal is exactly what they're looking for. Given negotiated transfers are highly customized, the deals only go through when a unique buyer is found where the seller value matches very well with the investor value so that a deal can be made. Because again, with these highly customized, so if the two parties don't see eye to eye, the seller is likely not going to sell. Next slide, please. All right, so this slide covers private auctions. So what are they? And on this slide, I do want to make a note that there are 2 different types of private auctions that we'll be covering in this presentation. The first is one-step private auctions. Then after this, Eric will present on 2-step private auctions. So unlike public auctions, private auctions are carried out via an intermediary, such as like maybe a private investment banker or a business broker, who attempts to entice a select group of private buyers into bidding. Private auctions may have 1 or 2 steps, as mentioned, in total. And again, here we'll be covering the one-step private auctions. SLE notes that when one-step private auctions are typically used when there's a limited number of buyers, where the likely buyers are typically known before the auction takes place. Typically, these are synergistic buyers, and I'll cover more of that here in a second. But first, it is important to understand what a one-step private auction entails and is all about. So there are certain steps that are carried out as part of the overall process. The steps are in order: execute a confidentiality agreement, much like a negotiated transfer, distribute a selling memorandum, accept visits from the buyers, call for offers, negotiate synergy sharing, execute a letter of intent, and finally, if all goes well, then again, closing. So with the steps out of the way, what I really want to hone in on is the synergistic buyers and why that matters and is relevant to one-step private auctions, as these are typically the buyers that are sought out for these types of sales. So why is this the case? With these types of auctions, an intermediary, again, such as a business broker, most common, will work with the synergistic buyers to show them how their benefit streams can be enhanced as a result of the purchase. Given market value is equal to the benefit stream divided by the buyer's private return expectation, and the intermediary, such as the business broker, only has control over how the benefit stream is viewed by the prospective buyers, the intermediary will work with the pre-identified potential buyers to show them how the benefit stream can be enhanced as a result of enhancing cash flow, for example, by merging administrative departments between the companies, thus cutting overall costs, conjoining marketing departments and slashing marketing personnel, thereby freeing up more cash flow, and so on. So in conclusion, this method, which is the one-step private auction method, they're great tools to use when a business can be sold to companies who can conjoin nicely and enhance cash flow as a result of many possible different synergies. So next slide, please, and it brings us to Eric.
Perfect. So just like Ari was mentioning about the one-step private auction, where it again is typically implemented or used when there's a limited number of buyers, and again, the ideal buyer will share a lot of synergies with the selling company. A two-step private auction, basically, the way I like to think about it is if you were like casting a net, wide net, and to kind of see what is out there as far as buyer potential. So it's a lot more formal than a one-step auction. And it's used if basically the business or that's being sold is extremely desirable, where basically, like, you know, again, I use the home buying analogy quite often, but it's basically like if you were going to buy a house, but you needed to have it inspected very thoroughly and have it underwritten and or have all the buyers underwritten. So like there's a lot more check boxes to check off before you can kind of get the deal closed. So two-step private auction is very rules driven. Each step of the process is staged using deadlines. So typically what happens, and you can see the kind of flow chart on the right-hand side there where it kind of goes through all these different steps, is first, you know, the business will execute a confidential kind of confidentiality agreement, and then distribute a selling memorandum saying like, hey, I'm about to sell this business here, and we're going to see what sort of other companies or businesses might show a formal expression of interest. The buyers then basically would visit a data room where they can collect a lot of underlying data and information and statistics about the business and how it operates and its you know, financial statements and fundamentals, to basically determine whether or not they want to put out an offer. And then what the buyers will essentially do is, you know, again, kind of put out offers. So the intermediary will call for final offers from all the various buyers. So again, you can kind of see how this process typically attracts more buyers than a one-step auction. Because again, it's kind of like putting out an ad in the newspaper saying like, hey, my business is for sale. So who wants to buy it? So again, the buyers do get access to data rooms to review more information about the subject that's in question and that is being sold. And in the offer, basically the buyer is requested to fill in the price that they would be willing to offer, as well as any other terms that they would want to see as part of the like closing or closing agreement. So things that are more peculiar or more specialized or individualized to their particular offer. As far as closing the deal, basically there's, you know, it can be extremely difficult because it's just dependent on the will of the parties. If either of the parties become disinterested at some point or dissatisfied, you know, eventually it does lose momentum or steam, like with many things in business, where again, if there's just not that due diligence or not that kind of effort put into place, the deal is probably just not going to close. So parties can't be lazy in this case. And again, as far as closing the deal, usually after a letter of intent is given and due diligence is performed, and again, they kind of check off all the check boxes and make sure everything checks out okay. The parties basically negotiate a definitive agreement, which is a legal agreement that contains basically a legal understanding between the parties. And usually this is best performed with multiple people on the team. So you want lawyers involved, you want CPAs and accountants involved, you want the owners involved, other professionals involved. So you can, again, leverage their knowledge or maybe use their expertise to help close this deal. You just want to make sure, again, that you kind of evaluate every single facet and aspect of a deal before you close on it, because it's obviously a big deal. So again, you can kind of see that this process is pretty tedious. It can take several months. You know, it's not something that just happens overnight, just because, again, a lot of information needs to be reviewed. So one thing the book mentions is that a good tactic is to actually have maybe like weekly conference calls or meetings. So typical issues that come up during deal closing can kind of be addressed or kind of tackled early on, instead of having it kind of just spring up at the very end right before closing and cause the closing to fall through and not go through. So when you have you know, these typical issues kind of tackled in kind of chunks leading up to the process, or leading up to the closing, it'll make the closing go a little bit smoother. So on the right hand side, there's all of this list of typical issues. I'm not going to go through all of them, but you can kind of just read through what some of the typical issues that might arise when it comes to business closing. But obviously there are some pretty big ones, like, you know, adverse changes to closing. If all of a sudden one party wants to change a significant portion of the deal before closing, obviously that's a big issue. There's other things like the amount being offered, or you know, it could be something where conditions, the closing conditions or business conditions have all of a sudden shifted or changed. So both parties might want to maybe renegotiate valuations. There's all these other things, from employment agreements for key employees. You know, if there is going to be a buyout, basically, you know, is the talent going to stay on and continue working for the company? So again, there's some other typical issues that you can see there on the right-hand side that you can definitely read on your own time. So after the transfer, after the closing has happened, basically the book wants to talk about kind of what are some of the what do the final steps look like, and basically where triangulation comes back into play again in this process. So if the owner has a strong management team in place, you know, they have other people that they've depended on, he or she has depended on during the entire time the business has been in operation, you know, a departure for that owner could occur very soon after the closing. Because again, the idea is to exit the business, right? It's to retire, it's to leave, it's to hand off the baton and give the reins to somebody else. But again, this can kind of only be done if there's already we wrote a case study about succession planning, but a succession plan or a good, strong management team in place that kind of already has addressed a lot of the issue with a business owner exit. So this does incentivize a owner to basically build a strong team over time, to again kind of keep them involved and keep them have, like, again, the succession plan or someone to take over once he leaves, because otherwise if the owner does not have a team in place, they might just need to stay on a little bit longer, so for a smoother transition after the closing. And the book mentions that sometimes this can be viewed as jail time, because when the new owners come into place and they implement new procedures, oftentimes it rubs the old owners the wrong way, and the old owners might not necessarily like what the new owners are doing, and they kind of have to just live with it, and they feel a little uncomfortable about it, but they're exiting. So a walk away without pay or penalty agreement should maybe be considered or negotiated, just in case the old owner just can't take it anymore. So timing is everything. Basically, again, this goes into triangulation, but a timing trifecta is achieved when your personal, business, and market timing all converge, which again very rarely happens. If that happens, that'd be the ideal environment. And because owners can't really control market timing all the time, they need to watch market movements and find ideal or opportunistic times for them to kind of make this exit, which again might not occur very frequently. So it is kind of rare for all of these things to align perfectly for the business owner that's exiting. Outside transfers occur again to the open market, which we actually addressed in our presentation last week. Everything is valued in the world of market value. So again, we're kind of finding companies where again they're kind of seeking synergies, such as sufficient size of a buying company or complexity. So if there is no kind of market value world that the business can be sold, or for this two-step auction to take place, then basically it can still be sold in the financial subworld. So again, just be evaluated based on the company and business's financials. Investment bankers really like the one-step process, just because for the most part, it's I guess more like focused, and there's just a set number of buyers. So typically, I think the process is a lot quicker. But what they'll typically do is invite strategic and non-strategic as kind of a backup or just in case contingency plan if no strategic buyers are in place to want to acquire the business in question. And the non-strategic, because again, might not really have any sort of synergies with the business. It will maybe venture into more of the financial subworld rather than the market value world. And then if that's the case, sometimes owners might want to stay on just to make sure that the transition goes a little bit smoother.
All right, before you go to the next page, can we go back? Okay, so typically, just one quick thing in here. Typically, these area, when a company founders, typically, and there are many research done around here, especially for the public traded company merchant acquisitions, when they are buying smaller firm, private firm, that when the founders actually stays, whether or not you call it jail time or whatever, when the founder typically stays within a period of time after the sold transaction, the company actually have better chance of succeeding overall. And part of the reason is not necessarily the founder's personality. Part of the reason is you have certain set of processes could be corrected. Plus you have your customer transition. Because oftentimes when you have buying, selling situation like this, usually the customers, you tend to lose customers when they know that the founders or key employees are leaving. So when transaction happened, there will be certain type of contract in place. And that is one of the issues that Eric identified previously, where you typically will have employment contract now with the founders, plus non-compete. And when you have non-compete, by the way, when you have a non-compete in place, the value of that firm goes up because that takes the owners much longer time to transition into whatever he or she wants to do. So there's a lot of moving target, if you will, for that purpose. All right, so you were going to answer questions.
Yep.
Yes, also, great. I'll jump on and do those. Also, Eric, if you can go back to, I think it's page 2 or page 3 to the channel chart, we'll use that for these questions. So the first question was, if the owners have knowledge and a long-term belief in the company, how does that impact the transfer channel? Yeah, perfect. So actually, I would say that that is almost the definition of what these transfer channels are about, which is that a company and the owner have a belief that they have something that they can make a transaction with. And so it's going to come down to what's the reason for the transaction, or what's the reason for the transition in the first place. That is then going to dictate the transfer channel. So I'd kind of flip that question around a little bit, honestly, to say that's exactly what the transfer is about and how this all works. I think a good example of that, though, is the question 2. So the question there is, why don't the private auctions, which are under outside retire, why don't those exist in the outside continue world, which is a different external transfer, right? I think the big scenario there would be if you have a owner who is wanting to sell to an outside entity, but still stay in the business. That's not going to elicit a auction for much like Ari and Eric just shared, because that's a entire entity transaction. That's a lot easier to look at. How do you have a synergy? How can you make that deal work? If you have the owner staying on and you're trying to come in with one fell swoop price to say, I want to make this transaction happen, it's so much more nuanced to have that owner stay there. And so to just come in boldly with an auction pricing strategy, I don't think really fits. So that's why it shows that there's the roll up or buy and build, recap type of a direction. I think that the question there about the RIA would be really, what is the motive of the owner? Is it to try to stay on but have employees ramp up, which would then go into more of an ESOP type of a scenario? Is it staying on but then bringing on outside ownership, right, which would maybe be the management buy-in, right, the outside owner is buying into that company? So again, it really, you'd go up the chain there to figure out what's the motive in both questions. What's the motive of the owner, to then walk through what the channel and method is going to be.
All right, very good. Thank you. Good job, Bears. Let's go to the group 2, please. Group 2, who's going to share the screen?
I can pull it up here since I'm going first, guys.
Okay.
All right. Everybody see that?
Yes.
Okay, sorry about that. Okay, so this week we're talking about outside transfers. Basically, that's with an outside entity consolidating similar companies, oftentimes in the same industry. When the consolidations teamed up with an IPO, they also refer to that as a roll-up. You can also have the outside transfers consist of the sellers transferring their share of their business to a private equity group that will use debt to often go out and purchase more companies. This is called a recapitalization. And it's important for the sellers to hire brokers, intermediaries, or other investment bankers, kind of what Ari and Eric had harped on, getting some specialists involved to look out for your best interest. So SLE has consolidations, again, defined as consolidations involve the initial acquisition of one or more platform companies, followed by the purchase of add-on acquisitions. As I mentioned, consolidations plus the IPO equals the roll-up, or a poof IPO. And then you've got the buy and build, which uses the private equity and debt for the acquisitions. The book also calls that the recap. So why would the sellers be interested in doing this? And why do consolidations exist in the first place? Well, a big advantage of doing the consolidations is cost cutting. A lot of combinations of staff, leveraging that with your vendors. Oftentimes going down to the last point there, the benefits of size. You can combine your size to get better discounts. We've talked for a couple weeks now about access to capital. The larger companies usually are able to negotiate better deals for their debt. Revenue growth, the acquisitions plus organic growth leads to faster growth. And then key management, the attraction and retention of key employees in that industry. Those key employees will also be attractive because you're going to be able to attract more sellers. So the price and the players, oftentimes with the consolidations, you're going to have those firms pay 5 to 6 times EBITDA. And then once it becomes a public listing, those investors that come in after the consolidations are often looking at a 10 to 15 times EBITDA. And the original people that put these together, they're even going to profit more from this. So the consolidators, the original sellers, are going to actually be receiving top price from the consolidators. And then the equity investors, as I mentioned, get that risk-adjusted return. The financial engineer and the investment or the investment banker, this is the main person here. They're going to attract the equity. They're going to do the negotiations with the platform deal, ultimately setting the tone for how this is going to take place. Key managers, as I mentioned, they're going to attract the sellers. And then oftentimes you'll need specialists involved, lawyers, accountants. If you're looking at a public listing, definitely the underwriters have a big voice in that. So transfer channels, Jeff just hit at this again. He also did it in week 2. Logan's also going to hit this up with the detailed slide that Jeff was previously using with the first group. But the first levels, the employees, the charitable trust, family, co-owner, outside retire versus the, or in the outside continue, and then the public listings. Again, as I mentioned, the roll-ups, consolidation of several smaller businesses into one large operation, which is simultaneously taken public. And then the IPOs offer large returns to investors and equity sponsors. But here's what to look out for and to address Group 1's question. On the consolidations, there's a lot of these actually fail. And it's because of the original plan going forward with them. If they're based on just raising a bunch of money, they're actually more likely to sell versus if they have a good structure in place with good key management. It's best to sell early. A lot of times you'll have investors in an offering before it goes public, and those investors will actually be offered tender shares or tender offers, which means you can get out without any market volatility at all. Oftentimes a few cents to a dollar more than what you originally paid in the first place. So there's no harm, no foul, and you've been getting the dividends the whole time anyways. Cash and not stock, that's the answer to your question. Anytime that sellers can get cash and not stock, that's going to be in their best bet, statistically speaking. And again, just be careful who you partner with. If they're not going to give you cash, then get as much as you can to take care of your own estate needs, make sure your family's taken care of, your grandkids, whatever you need for your retirement, and then take the rest in stock. And with that, I'm going to turn it over to Logan.
Hi, so I'm going to talk about the buy and build of recapitalizations. You can excuse the bullet on the left and the bright orange are duplicated just a little bit, but the bullet points go with that. Basically, as Chris was stating, it's just a method of consolidating companies in an industry. Perspective is really the main difference, the owners versus the private equity groups. As far as the recapitalization goes, the book kind of sectioned that off into an owner selling his or her share to the private equity group and then maintaining operating in that business. Whereas the buy and build, it's actually acquired by the PEG. And then from there, they try to build on that using their own value adds. Let's see. What was interesting is the book pointed out how PEGs use the buy and build as a central model quite often as it maximizes their exit. Next slide. Thanks. And so moving forward with recapitalizations, so like I was saying, the owner sells part of the company while operating the business and involves a change of control. Benefits of the recaps that were pointed out by the book: increase in personal liquidity, continue operating the business with significant equity position, eliminating borrowing guarantees, decreasing personal risk, so not owing as much, gain access to exit planning professionals. I think Chris and the first group talked about using these professionals to the business advantage. That's so important, as opposed to just relying on what the business owner or one individual thinks in a given situation. And then possibly receiving non-diluting capital for growth. And then the next slide here, this is what Chris was talking about. I like this graphic a lot, and group one used it too, the one on the left, showing the transfer channels. And then you can see the buy and build recaps there on the right-hand side. And then where I pulled that information from on my first slide, under buy and build, the definition, and then under recapitalization there. And I really like how it points out the owner motives, because that's kind of what is driving it. We talk about the business model driving succession, and that also implies the owner motives, or even sometimes the buyer, depending on what they want to do with a specific company. I'm going to pass this off.
All right, so this is the introduction to sort of our next section of the chapters that we had. So we're going to talk a little bit here about going public and going private. So first of all, what is taking a company public? And that's when you're offering stock for sale to the general public, and you could do that in several different ways. One is an IPO, which most of us are familiar with, an initial public offering. For taking companies public, you know, you get the underwriters, everything else. One of my other colleagues or my teammates is going to be explaining that a little bit more. And then there's direct public offerings. And then another way a company can basically go public is if they want to do it quickly and don't want to have to go through all the underwriting, you just simply merge with a company that's already public. They call it a reverse mortgage. And it certainly streamlines the process. So instead of going through and registering with the SEC, you just do the reverse merger. But the direct public offerings is something that I found pretty interesting, because I wasn't entirely familiar with them, and I'm going to be talking about that on the next slide. But of course, there's some reasons to go public. A big part of it is that you're trying to raise capital to fund your growth. All right, so you sell shares of the company. You could take that money, use that to finance your growth going forward. A big part of it is that you could use the stock in order to acquire other companies. Could help, you know, the owners diversify and liquefy their person, but also there's a big part of the ego involved in it. Okay, you know, we're public now. Woohoo! We've hit the big leagues. And when it boils down to it, only 0.1% of all companies in the United States are actually publicly traded. It's not a lot of them, but as the book kind of mentions, it's sort of like a kid playing baseball in the sandlot. You know, he's going to make it into the big leagues one day, no matter what. And that has a lot to do with it as well. But there's certainly a lot of drawbacks, and there's a lot of reasons to stay private or go private. Probably the biggest reason is that you don't have to deal with shareholders, right? I mean, you get to maintain some control. Of course, you don't have to do all the same level of reporting that companies registered with the SEC has to do, to show all their financials and all of the internal workings of the company. Of course, you know, a lot of times people who are investing in companies want short-term results. So companies that really have a much more long-term vision frequently will avoid going public. It's a lot of costs involved in it. And really, when it boils down to it, for quite a few companies, the benefits that you get from going public just don't justify the cost for doing it. So go ahead and switch to the next page there. So this talks about direct public offerings, which I found pretty interesting. And the very bottom bullet point here says that unlike with initial public offerings, a direct public offering does not a public company make. It gives you the ability to sell shares of the company to the general public, but you're still considered a private company. All right, so it's somewhat unique. And really what it falls under is some of the rules with Reg D and some other rules that kind of give them some exemptions to do that. Now, there are some limitations to that. And when you're looking at going public, and one of the things the book mentions is that until a company has a size of about $1 billion of value, And usually companies don't put all of their shares as an offering. They're usually looking at 20% or so. That really, until you get about $1 billion, it doesn't really do much for you. Your shares are so thinly traded until you sort of hit this critical mass of around $250,000, $300,000, really to make that worthwhile. But direct public offerings allow you, they're sort of like a private placement, but you don't have to have a prior existing relationship. They're sold to the general public. Those shares could be traded, but usually they're very thinly traded. There's also some limitations when you look at a score, which is mentioned at the bottom, the Small Corporate Securities Offering Registration. Is generally the simplest and most common type of DPO, but there's some limitations. You can only collect or generate up to $1 million in any 12-month period. So depending on the size of the business and what your goals are, you're somewhat limited. There are other types of DPOs. So generally a company who starts by doing the score method later on might sort of take some steps into some of the other DPO methods. So score is not the only method, but it's a pretty good tool for raising money, and a great way for smaller firms who are sort of maybe looking for venture capital in some ways to start offering those shares and try to start and eventually get a lot more trading ability and trading, I guess a level of trading where you've created a market. It's a great place to start. So otherwise, I will end there, and why don't I turn it over to Jade?
So before you go to the next page, can we go back? So questions for everyone is that each state, not all the state, but most of the state also have a crowdfunding. Does anyone know your own state's crowdfunding limits compared to DPO? DPO is at a more of a SEC level. Each state has a crowdfunding available, which is also different than a DPO. No? That will be something to look it up for next week. Logan say California is $1 million. I don't, is it $1 million? It probably more than that. Typically goes anywhere between, go ahead, Logan.
I can look it up.
Yeah, just look it up because it's
I was doing the same thing, Ari. I'm trying to find.
Yeah, because typically the DPO sounds great, but you have to deal with SEC. But if you don't have to deal with the federal level, but you have a state level doing crowdfunding, it is still quite effective, very much like a DPO. You still have to go through some hoops, but there's a maximum for that particular type of offering. Okay, so Jordan mentioned 1 million in Utah, okay. I know in North Carolina, it's 2 million. And then if you can offer this not one-time deal. Did anyone find the California?
In Washington State, it's 1 million.
Okay, Washington State's million, okay.
I'm still looking. I saw that the SEC has a cap, which is $1,070,000. I don't see if California has a number. It might just be the SEC cap. I'm still trying to find it.
So it sounds like Washington's $1 million, Utah $1 million. I think North Carolina is 2, and then California you say is what, 1.75? Is that what you're saying, or just 1?
1,070,000.
Okay, so 1.7. Okay. All right, so that would be something that if you were to work with a owner clients, be sure to make that comparison. Okay, thank you.
I found California's 1 million.
You found 1 million?
That's what I see. California funny makes its way through legislator. Fundraising limit 1 million per year.
Okay, per year. So there's you could do it multiple times. All right, great. Thank you.
Okay, so I can start?
Yes.
So thank you, Jeff. So I want to presentation for the initial public offering part. So I want to start with advantages and disadvantages of the IPO. As Jeff already mentioned that the main advantage of going public is accessing to long-term capital for a company. The public market are larger, more liquid, and less costly than the private capital markets. So the main disadvantages to going public is that the public company must follow complex security laws. Like the public company must file public disclosures with the SEC. Report include quarterly report 10Q, annual report 10K, and periodic report 8K. And the financial statements are always audited. A public company has a potential liability of insider trading. The owners cannot sell their stock for a period of time that is a lockup period for the insiders rule. Sarbanes-Oxley Act, also known as Public Company Accounting Reform and Investor Protection Act, created lots of regulations for the public company on internal controls. So these are the main disadvantages for a public company. Next page, please. The underwriter, usually an investment bank, is a leader of the team for the IPO process. The IPO begins with the organizational meeting to identify the offering time and the participants' responsibilities. Then the lawyers draft the registration statement. A due diligence matters process is a review to determine whether any security holders have preemptive or registration rights that may be triggered by the offering. The next step is initial filing for SEC. After the initial filing, there's a quiet period. During this period, the company refrains any information that is not included in the registration statement. After that, the company and the underwriter conduct a roadshow at large cities with large institutional investors. After the roadshow, the offering price is confirmed. If the offering price if the offering is priced when the market is open, the closing will take place 3 days later. If the pricing occurs after the market closes, the closing will be 4 days later. So totally, IPO requires 6 to 24 months to complete. Go to next page, please.
Can you go back, please? Can we go back? Okay, thank you. So even though we're talking about the IPO, that process, but I wanted to kind of point out to everyone in terms of the private transactions, not non-IPO, the due diligence would take anywhere between 12 to 24 months, depending upon the industry. So oftentimes when you work with your owner clients, you need to set a proper expectation. It can be speed up, but still somewhere between 6 to 12 months period of time. So you need to factor all that in. If someone who is in a hurry to get out of the business, you just have to be honest with them. The due diligence does take a long time. Minimum 6 months and upwards of 24 months if it's a larger company. Okay, you can go to the next page. Thank you.
So go to public or not. Here's some key considerations. The first consideration is the size matters. If a company doesn't have hundreds of millions in float, it cannot gain the benefit of being public. Another consideration is most companies are not qualified to list it on national exchange, but they wish, and they have to go to OTC or a minor exchange. The management team of the public company must share a corporate vision, not one person's vision or the owner's vision. Earning growth is a pressure. The stock market will punish the companies that fail to the earning to growth. Another consideration is market timing. It is very difficult to achieve a good price in down cycle market. The last consideration is cost. the cost of the IPO is very expensive. It's cost about 8 to 10% on large size transaction and 15 to 20% on smaller transaction. For NASDAQ, the expenses are typically $25 million to $50 million. Now, please let Jeff to continue.
All right, thanks for that. So I'll talk a little bit about reverse mergers. Essentially, it's a mechanism to convert a private company into a public entity. And how it generally will work is the private company will gain control of the public company by merging it with that private company. Some of the big benefits are kind of in contrasting to what Jade just mentioned. It can be accomplished very quickly. It can save up to a year or so as far as making a private company public. And it can also limit the expenses greatly. It can save millions and millions of dollars. The general expenses of a reverse merger are usually under $1 million in costs, plus a percentage of equity, which is usually a pretty small percentage of equity in the remaining company once the reverse merger has gone through. So how it generally does work is that the shareholders of the private company essentially swap out their shares for new or existing shares of the public company. So at that point, they'll hold the majority of the public company shares, which will allow them to control the board, allow officers and directors of the public company to give way to those who are in charge of the private company, and they'll essentially move forward leading this now public entity. Did want to talk just briefly about an example of what this might look like. Not sure if anyone remembers a potential merger from a couple of years ago of Albertsons and Rite Aid. I have a couple in-laws who work for Albertsons, so it was definitely a hot topic for a little bit of time there, so I know a little bit about it. There's certainly some synergies involved, some value add that would have happened, but a big part of it was to take Albertsons public. And the backstory of it is back in the mid 2000s, I think it was about 2005, 2006, Albertsons was going through some struggles. And a private equity firm, I think it was Cerberus Capital, came in, essentially bought out Albertsons and leaned out the company, made it profitable, and have built it up ever since to what we now know it as today. So considerable time, considerable effort, considerable money and leverage that they put into this. It's been 14 years or so. It's a long time for a private equity firm to be invested in a company like that. So a couple of years ago, they had this opportunity to merge with Rite Aid, and a lot of the idea was that they would be able to cash out some of that equity they'd built up, get their money out, maybe put it to use for something else. And so they had made an offer to gain control of all of the shares of Rite Aid, and the CEO of Rite Aid was actually going to stay on and run the resulting company, so Cerberus kind of pull out from it. The shareholders of Rite Aid kind of nixed it. They didn't like the price that was offered, so that never actually happened. But that was one thing they were trying to do. And I think just recently, maybe even last week, Albertsons finally did go public as they're trying to get some of their money out, divest a little bit from the interests for Cerberus. So just thought it was an interesting example of what it kind of does look like and certainly can happen out in the real world. And at this point, I'll turn it over to Dave to continue.
So another example would be, so Dell years ago became a private company. They converted into a private company, and then enabled for them to become public again. They merged into AMD, and AMD is a public company. And so that's exactly what Jeff was saying. It's the fastest way to get back to the public company without spending a whole lot of money. So that does happen. I believe Charles Schwab was public before, turned private, and then turned public again. Although Charles Schwab didn't buy any public company when they turned public. But there are a few examples like these. Okay, thank you.
Sorry. Just forgot to turn off the mute. Jeff, great job. Thank you. And yeah, Albertsons went public on Friday of last week, I believe.
Good.
Yeah. So my section is to cover going private. And a company goes private when the shareholders shareholders fall below 300. And you have roughly about 500 companies register each year. I don't know if many people remember back in 2018, Elon Musk threatened to take Tesla private at 420, funding secured. You know, he's always touting things, but that was just something I remember when thinking about this type of topic of Elon Musk just recently with Tesla. Some of the transactions that could take a company private other than a rogue owner is another company or individual making a tender offer to buy all or most of the company's publicly held shares. If a company merges or sells with another company's assets to another private company, or the company declares a reverse stock, merge or sells with the company can declare a reverse stock split that not only reduces the number of shares, but also typically reduces the number of shareholders and maybe brings them down below that 300. SEC rules that public disclosure of the reasons for going private. So if a company wants to do it, they can't just do cloak and dagger and just pull right out and just do it. It's quite an elaborate process and a lot of legal potential there for lawyers to sue. Alternatives that the company may have considered and whether the transaction is fair to all shareholders. Next slide, please, Chris. In the topic, it talked about getting delisted for the NASDAQ. Actually worked for a company that was on the NASDAQ, was trading at about 30 bucks right before the Great Recession. It was a bank that I was working for. They followed companies and some of their big clients to areas that they just weren't well versed. And when the Great Recession happened, it just took them by storm, and their stock went from, you know, splitting every couple of years, making everyone super wealthy, to falling down to about 62 cents per share, then fell down to 39 cents per share. Then we had a Texan billionaire, Gerald Ford, came and bought them out. And so they went private just because a billionaire came, and that's what he does. He buys distressed banks, flips them, and then sells them. Ended up selling them to Union Bank. So that was quite the experience to go through. So seeing this in the book, it was a topic I had to bring in. You know, there's reasons companies could be delisted. One, takeover, like I was just talking about, and the other is stock price trading below a specific price for a certain amount of time. So when you trade below $1 for 30 consecutive days, you're going to get a deficiency notice. And then the notice warns that the company has 90 calendar days after it's been under $1 for 30 days to bring it up to above $1 for at least 10 consecutive days or be threatened to be delisted. And then there's some companies recently that I found in there. Luckin Coffee, it's a Chinese coffee company, is in the process of getting threatened to be delisted from the NASDAQ currently. And then you also have MoviePass, which it wasn't MoviePass that was public, it was a parent company that was public, and they just recently got delisted as well. Chris, if you can go to the next slide, please. Chris?
Yeah, I think you're freezing on us, Dave.
He's using cell phone in the car.
Yeah.
I think we can skip this portion. This one is being
My connection
talked
in the
about.
car is not super great.
Yeah, we noticed that, but I think this portion could be skipped.
Yeah, that's all together.
Yeah, so did you guys answer the questions through the presentation, or do you have any questions that you need to answer?
I know I knocked out the first question when I was speaking. Dave covered y'all's second question, but I'm not sure if we got into the details of what you all were asking. So please let us know if we need to expand on what he was presenting.
I don't remember what the second part of the question was.
No, there was a question. There was a question, why do you think so many companies go public and then back to private? And I don't think we addressed that question specifically, but I think we covered it in the course of our presentation here. But if somebody has an additional question or wants us to elaborate, please let us know.
Okay, sounds good. Thank you very much. Great job there. Both groups did a great job. Chris, would you mind to stop sharing your screen? And Ari, would you mind to share your screen? So we're just going to go to Blackboard real quick. I want to
Sure.
make sure that we can see that group assignment of week 5.
And can everybody see my screen?
Yes, I can. Yeah. So let's go to Blackboard real quick.
I just looked too, and I can see the group presentation now as well.
Okay.
In week 5.
Just want to make sure that we have that showing up correctly.
So we're going to week 5.
Week 5.
Okay.
Just want to make sure that you can actually
Yes,
see.
I see the group presentation now as well.
Okay,
Yeah.
good.
That's in there.
Okay.
Here.
There.
So it's in there. So really for next week, your assignment would be the literature review of the 5 article plus your week 2 revision of the research questions. Then your week 5 presentation, you will be able to see the group 1 is doing ESOP and management buyout. Group 2 is doing family transfer and co-owner transfer. So the ESOP is going to be very, very heavy topic. So be sure to have some sort of example in your presentation. We may end up just doing 1 or 2, but both, depending on the times that we have. All right. Does anyone have any other questions? For week 4, other than the literature review and revision of week 2, you also have discussion. There is 3 questions on the discussion where you will watch a video and then answer 3 questions on the week 4 discussion. So there should be 3 questions there. Okay, so that should be, let me double check.
But, so do we only answer 1 question?
No, you answer all 3 questions. But what you do is when you reply to someone else's comment, just reply one person's
Okay.
reply, if you will. Okay, so it's only reply to one person's post. That's all we need. You don't need to reply to all 3 questions. Does that make sense? That's just kind of save you a little bit more time on the discussion portion.
Mm-hmm.
So we should just have 1 reply in total, not 1 reply to each
That's right.
question. Does someone else? Okay.
Yeah. Okay. All right. Any other questions?
Wait, 1 reply to each of the 3 questions though. Like, so we write an original response to your 3 questions that are posted, but then we also reply to one of our classmates in each of the 3 sections?
Just one.
Okay.
Let's say Eric has answered 3 questions, right? And I reply to one of Eric's posts. That's all you need to do. Make sense? Still confused? Your total replies is 4.
Okay, got it. Okay, that makes sense.
That'll be a little bit easier that way. 3 of my questions and 1 of your classmates.
Got it.
Okay.
And how long is the video?
I don't remember. Ari, could you?
It's an hour long.
Is it
Yes.
an hour?
Let's see.
It's an hour.
Let me go back.
Can you guys hear me? The video is an hour long.
Okay,
Yeah.
good. Thank you. All right. Are there any additional questions? I'm looking forward to reading your literature review, by the way. The case study, I was very, very pleased with the case study that you came back with. Great job for everyone. So keep up the good work there. Any other questions from anybody?
Not a question, but just something to let you know is that I think for week 6 and 7, the presentation is also still hidden from us.
Okay.
So
All right.
Yeah.
I have to go beat up the CTL then. They messed up with my Blackboard. Okay, so week 6 and 7. Okay, we'll do. Thank you for that. All right, with that, be sure to also answer the midterm survey, which is just 4 or 5 questions. And that just let me know where you stand as of now and if there's any changes needs to be made to the class. Okay, enjoy the week, and I look forward to reading your research paper on the literature review. All right, have a great night, guys.
Thank you.
Thank you.
Good night, everyone.
Thank you.
Thank
Have a
you.
good night.
Bye, everybody.
Bye.